Assalamualaikum and salam sejahtera. Hi everyone. So this video is prepared for the discussion of tutorial 2 topic 3. Alright, so in this question you are required to state the effects and also to prepare the journal entry for each of the business transaction here. Alright, so what are the transaction that we have here? Okay, so instead of looking here, okay, reading on the business transaction, okay, so I have turned everything into an illustration, all right, so that some of you would understand better. Okay, all right, so the first transaction, if I'm not mistaken, is where cash RM 20,000 ringgit and motor van 47,000 ringgit were brought into the business. So who brought cash and motor van into the business? Of course, the owner of the business. All right, so what happened here when the cash all right, so what happened here when cash RM 20,000 and motor van 40,000 were brought into the business? Okay, so when you prepare the record, okay, you have to, when you prepare the record, um, you have to put yourself, okay, in the business perspective. Okay, you are the business, you are recording for the business. Okay, so we have to put ourselves in the business. All right, so now instead of looking at the owner, all right, so we are recording on the business part. So now from this transaction, what do business has? All right, so from this transaction, the business now has cash and also a motor van. So these two are in the category of asset. So what happened to the asset of the business? Asset of the business will increase. At the same time, okay, they need also to record the contribution from the owner. Okay, they need to record the contribution from the owner. All right, so what about the contribution from the owner to the business? Increase in capital. Increase in capital meaning increase in owner equity. So I put it here as equity. Okay, so asset increase, equity increase. All right, the other transaction, second transaction, if I'm not mistaken, okay, received check 8,000 from Safwan Berhad, okay, from the last month, for the last month invoice. So why Safwan, okay, had invoice of this business? All right, and then why Safwan, okay, gave check to the business? All right, so now what do business have? So business receive check, meaning that receive cash at bank, receive money. Okay, so receive money, money is asset, so asset of the business will increase. So here asset increase, of course, because of the check. All right, but last month invoice, okay, what about last month invoice? How Safwan receive invoice from the business? Okay, and why do Safwan needs to settle the amount of money to the business? All right, it means that in the previous month the business sold goods on credit and issued invoice as a source document or as a evidence to Safwan Enterprise in the last month. Alright, so Safwan received goods from the business and they receive also the invoice as a supporting document. Alright, and then okay, in the following month, so Safwan settle his, or not settle, maybe part, maybe settle, okay, of his account. Okay, so what happened in the last month when we sold goods on credit to Safwan? We create account receivable. Okay, so we create account receivable for Safwan. Okay, we have created account receivable for Safwan. Okay, so what, so account receivable is asset. Okay, account receivable is asset. So what happened to our asset when we first create asset account? When we first create account receivable for Safwan, our asset increase at that time. Okay, because it is a money that we are going to receive in the future. Okay, so that is an asset account. All right, okay. So when Safwan set the parts of asset of account receivable, okay, set the part or all of account receivable. So what happened to account receivable? Account receivable of Safwan Enterprise will be reduced. Therefore, asset also will be reduced or asset also will be increased. So in this case, okay, so for the second transaction, the effect is asset increase, asset decrease. Asset increase due to cash at bank, asset decrease due to account receivable of Safwan Enterprise that we have created in the previous month. Okay, all right, and the next transaction is, okay, let me go back because I forgot the third transaction. damaged goods were returned to Yuha Enterprise with a value of 380. Okay, damaged goods were returned to Yuha. Okay, so damaged goods were returned to Yuha Enterprise. So this is Yuha Enterprise. Okay, return goods meaning that the business, okay, take out the goods, okay, the stock, and then return to Yuha Enterprise. So why the business return goods to Yuha Enterprise? Okay, most probably in the last month the business purchased goods from Yuha Enterprise. Okay, most probably in the previous month. Okay, so what happened in the previous month? Business purchased goods from Yuha Enterprise. So at that time we have recorded an increase in our expense. Okay, purchase goods is expense account. All right, so what happened in the previous month? In the previous month we have recorded increase in expense. Okay, because we purchased goods from Yuha. Okay, assuming we purchase on credit, because it is not stated, so assuming we purchase on credit from Yuha Enterprise, so when we purchase on credit from Yuha Enterprise, we are going to create an account payable. Okay, we are going to create an account payable, okay, for Yuha Enterprise. Okay, for Yuha Enterprise. All right, so what happened now? Okay, so account payable is a liability, yeah, because when we purchase on credit, okay, when we purchase on credit, what happened is, okay, when we purchase on credit, what happened is we have create a financial obligation that we are going to make some payment in the future. All right, uh, so now what happened is, out of the goods that we purchase, okay, there are some damage to the goods and we return back to Yuha Enterprise. Okay, so if previously we have recorded increase in expense, so because we return the goods, okay, so when we return the goods, what happened to the expense? Expense will decrease, expense will decrease. Okay, but do we record in account purchase? No, we are going to create a new account called return outwards. All right, return outwards, because we return, um, we are taking out the goods. All right, so return outwards. Okay, okay, and then what happened to account payable? So when we first purchase, okay, there is an increase in liability, but now when we return the goods, so we have to also reduce the liability. Okay, we have to reduce the liability because we return the goods, meaning that we don't have to pay as much money that we owe to Yuha Enterprise, because we already returned some of the goods. Okay, so we have to reduce in our account, and then we're going to pay only the balance. All right, okay, so what about the next one? So the next transaction is the business paid the annual insurance premium of 1,200 by check. All right, so so the business made a payment to the insurance company for the insurance premium. All right, so this one. Okay, so what happened when the business take out the money and then pay to the insurance company? Okay, so what happened to our cash? Cash reduced. What happened to the asset? Asset also will be reduced. Asset will be reduced. Okay, for what purpose this asset is reduced? Because we are paying for the insurance. Okay, so insurance is an expense. So what happened to our expense? What happened to the recording of our expense? We have to record. We are going to increase in our record, right? So we have more expense now. So expense increase. Okay, all right, so we are recording the expense. Of course the money is decreased, but the expenses increase. Okay, next transaction. Okay, purchase 3,700 of stock on credit from Hanis Sendirian Berhad. Okay, so purchase on credit from Hanis. Okay, so this is Hanis Sendirian Berhad. So the business purchase goods on credit. The business receive, okay, the business receive goods. Okay, all right. So purchase goods. Again, yeah, purchase good is expense. Purchase goods is expense. Whenever you make a purchase, you increase the expense. Okay, all right. Did you purchase by cash? No. Okay, no cash involved, so no money outflow here. But okay, the goods were purchased on credit. So when you purchase on credit, you have created a financial obligation that you promise to pay to the Hanis Sdn Bhd in the future some amount of money. Alright, so when you create an obligation, so that will be recorded as liability. You are going to create an account payable for Hanis Berhad. So account payable is a liability. Okay, account payable is a liability. So what happened to our liability? Liability also increase. All right, liability also increase. Okay, next. Okay, next transaction is, okay, the business purchase office equipment on credit for 3,200 from Far East Sendirian Berhad. Okay, so another purchase. Okay, seems like another purchase, but look at the goods. Okay, look at the item. Sorry, not the goods. Look at the item that were purchased. Okay, they purchase office equipment. They purchase office equipment. So the purchase of office equipment is not an expense. Office equipment itself is an asset. Okay, so when you purchase an office equipment, so the business receive an office equipment. What happened to the asset of the business? Because office equipment is an asset, you purchase because you need to use the office equipment in the administration of the business. All right, and then you are going to use for more than 1 year, so that meets the definition of asset. All right, so asset will increase. Okay, but you purchase on credit. You purchase on credit, so you are going to create account payable. Account payable. So what is account payable? Liability. Right, this is liability. So what happened to your liability now? Your liability increase. Okay, your liability increase. All right. Okay. Okay. And then the last one, if I'm not mistaken, so the last one is payment of utilities and rental of 2,100 and 800 was done respectively by check. Alright, so the business take out some of its money, alright, and then make a payment to the landlord for the rental, and then for the utilities to the service provider, alright, depending on the types of the utilities. Okay, so we have here, so what happened to the money? So the money here will decrease because we made the payment, alright, the money will decrease. Okay, but the rental expense will increase. Sorry, the expense will increase here for the rental, and the expense will increase here for the utility bill. Alright, okay. Alright, so that's all for the discussion of the effects. Okay, so now let's move on to the journal entry. Okay. Alright, so now let's look at the journal entry, okay, for each of these business transaction. Okay, so we have discussed on the effects, alright. We have discussed on the effects just now. Alright, so now let's look at the journal entry. Okay. Increase in asset. Increase in asset, debit. Increase in asset, debit. Okay, what asset account to be debited? Number one, cash. Alright, of RM 20,000. Alright, another asset account to be debited is motor van, RM 47,000. Okay, alright, and then equity increase. Equity increase credit. Equity increase credit. Okay, what equity account to be credited? Capital account. Okay, so you may show separately for cash and motor van, or you may combine the amount. All right, so I choose to combine here. All right, for the journal entry. Okay, next. Okay, increase in asset debit. Increase in asset debit. Which asset account increase? Check. Check is cash at bank, so record as bank. Okay, bank RM 8,000. Okay, do not record as check. Okay, record as bank, which represent cash at bank. Alright, asset decrease credit. Asset decrease credit, but which asset account here is being decreased? Okay, account receivable of Safwan. Okay, account receivable of Safwan, because in the past we have recorded an increase in account receivable, increase in asset. Okay, when Safwan purchased goods from us on credit, meaning that we sold goods to Safwan on credit. At that time, there is an increase in revenue, increase in account receivable, increase in asset. Okay, but then when Safwan made the payment, so we receive money, all right, and then we have to deduct from Safwan accounts. Okay, all right. Next, damaged goods were returned to Yuha Enterprise with a value of 380. Okay, assuming this is a credit transaction as well. Okay, so why did you return goods to Yuha? Because you have purchased previously. So you have purchased previously the goods, then you return. So the first time when you purchase the goods, you record as increase in expense, increase in liability. Okay, assuming that we purchase on credit. So when we return the goods to Yuha, so what happened here is that, okay, our expense will be decreased. Okay, expense will be decreased. So expense decrease, credit. Okay, so which expense account to be credited? Okay, we do not credit purchase account, but we are going to create an account called return outward. Okay, return outwards. All right, so return outwards or purchase return, it will be the same. Okay, return outward or purchase return. All right, and then we are going to reduce account payable of Yuha Enterprise, because we have returned the goods to Yuha, so we don't have to pay this RM 380. Okay, next. All right, the business paid the annual insurance premium of 1,200 by Jet. So we have discussed here. Okay, decrease in asset, increase in expense. Okay, increase in expense, debit. But which asset account to be debited? Insurance. Okay, you simply put that as insurance, RM 1,200. Okay, what about the decrease in asset? So decrease in asset, you credit. Okay, which asset account to be credited? Okay, so asset that affected here is cash at bank. So bank, RM 1,200. All right, next one. Okay, increase in expense. Increase in expense, debit. Okay, which expense account to be debited? Purchase of stock. Okay, so we record purchase. Purchase of stock, we record purchase. We do not record stock. Okay, we record purchase. So purchase is an expense account. Okay, belanja. Alright, the main expense. Okay, is the purchase. Alright, and then in decrease in, sorry, increase in expense, increase in liability. Why increase in liability? Because, okay, you did not pay immediately, but you are going to pay in the future to Hanis Sdn Bhd. You have created a financial obligation. All right, so increase in liability, debt, credit. Okay, increase in liability, you credit, and then you're going to create account payable of Hanis Sendirian Berhad of, okay, how much? Of RM 3,700. Okay, next. The business purchase office equipment on credit for, okay, so this one also increase in, sorry, increase in asset and increase in liability. Increase in asset and increase in liability. Okay, so increase in asset, we debit. Okay, increase in asset, we debit. But which asset account to be debited? Because this one is purchase office equipment, we purchase the asset. We are not purchase the goods to be sold. Okay, but we purchase the asset, so we are going to record that as an asset. Okay, so office equipment, RM 3,200. Okay, and then increase in liability, you credit. But which liability account to be credited? Again, you are going to create account payable. You are going to create account payable, okay, for Far East Sendirian Berhad. Alright, okay, of the same amount, RM 3,200. Okay, and the last one, okay, increase in expense, decrease in asset. Okay, so we increase in expense, you debit, but which expense account to be debited here? All right, you can either do it separately or you combine. So if I want to do it separately, it would be like this. Okay, utilities Okay, RM 2100, and then bank RM 2100. All right, and then we have here rental expense. Okay, RM 800. All right, and then here bank RM 800. All right, so if you decide to combine, that one also is not a problem. All right, so this is the answer, okay, for tutorial 2 topic 3. Okay, tutorial 2 topic 3. Okay, so thank you.